Have you ever noticed why the market seems to reverse at the same exact level again and again? This is not magic, it's mathematics. Traders around the world rely on a simple tool to spot hidden support and resistance, and this is called as Fibonacci. In this video, I'll give you a clear detailed roadmap how to use it, even showing you how to use it in the live markets. So starting off with Fibonacci. In this video, you'll be mastering the entire Fibonacci tool. First, we'll start with what is Fibonacci? Why do traders use it? So the numbers behind the tools. When you apply Fibonacci indicator on your charts, you will see different numbers 0, 1, 1, 2, 2, 3, 5, 8, 13 and so on. So traders generally use this to self-fulfilling prosperity. Millions of traders watch the exact same level reverse at the natural pullback zones. So it is basically a level where all the traders combine together and sell to make profits and losses. Now, what is Fibonacci retracement? There are total 5 key levels, okay? Starting off with 23.6. This is a shallow pullback. This means market has given a light pullback and then reversed. It can even go higher. Chances are there of going higher. 38.2 is a moderate retracement zone. 50 is a psychological midpoint. Not the true Fibonacci ratio, but it is a psychological midpoint. So traders generally trade based on 50% returns also. 61.8 and 78.6. 78.6 is generally avoided because this can be a sign of market reversal as well. But 61.8 is the golden zone. It is a golden ratio. Most traders trade this level. So you can see when you apply Fibonacci onto your trading view, you'll find like this different zones. Markets never move in a straight line. They always moves with lower high, lower low, or higher high, higher low. So this previous lows which you see, these are called as the retracements. Now, at what level will this retracements be made? The prediction of the levels through Fibonacci. This is how we trade Fibonacci. Now, how to draw Fibonacci retracements correctly. First thing, identify a swing. Take a trend. Next, watch the reactions. Now, common mistake, people generally draw Fibonacci based on when markets is choppy or sideways. But Fibonacci does not work when the market is choppy or sideways. Now, let me show you an example. This is I'm opening a trading view chart of Euro USD. So this is a Euro USD chart. I have just drawn the simple support and resistances. You can ignore that regions. Now, when we apply Fibonacci indicator from one high to low, Fibonacci is generally applied from a high to low. You can clearly see that market has tapped the Fibonacci golden zone, which is 0.618 and 0.5. So when it tapped the zone, it gives a very strong reversal, which is very good for trading. Not only here, you can check it out in some other zones as well. But you should just make sure that the trend is very, very sharp, because in choppy markets, Fibonacci does not respect choppy markets and it does not work based on choppy markets. Now, if you look at a trend here, if you apply Fibonacci from this high to imagine this low, you can see market has given multiple taps here. One tap, twice, thrice, and it has given a very strong pullback from here. So that is how you apply Fibonacci on your live trading view platform or any brokerage platform which you use. So now coming back to Fibonacci extensions, targeting profits beyond 100%. So here 127.2, 161.8 and 261.8. There are three, out of 5 zones, these 3 are more important. And the most important is this golden extension. Few people call it golden pocket, few people call it golden leaf, few people call it golden zone. So this is the most important zone because most of the traders are waiting for the market to tap here and then they sell. Now Fibonacci works best in trending markets. When a strong uptrend is there and then you apply Fibonacci, you can get a good clean level of 38.2 and 61.8. Then you can wait for a nice bounce back or a trace, retrace. But in a consolidating markets, if I show you a few consolidating markets example, let's imagine, okay, this thing here. You can see Euro USD was consolidating from this zone to this zone. So here if I take Fibonacci from like this high to this low, it makes no sense. Fibonacci does not work here. Every time the golden zone or the golden pocket is broken, and it never made any sense. So we should always take Fibonacci in a very good uptrending or downtrending markets. And next thing, what is the, how are these zones made? And you have different strategies which I'm going to say you here. You can either pair up Fibonacci levels with support and resistance, Fibonacci levels with moving average, Fibonacci levels with trending or channel boundaries, Fibonacci levels with psychological round numbers. Now what are psychological round numbers is basically it is like a number with zeros in end. 1.5800, 5800, 1.200, the end of numbers like 100, 200, 300. These numbers are called as psychological levels, and these are four strategies here for you which you can easily use. And if you want a video on support and resistance, moving average, trending, these all are already been uploaded. You can just check out these videos and this Fibonacci level video. You can combine and make a really good strategy. 61.8 is the golden pocket zone. You can combine it with 200 EMA, which is acts as strong support and resistance. Now there's one more setup for you. After these four strategies, if you are not interested in those four strategies, then another strategy for you, combine Fibonacci with candlestick confirmation. Now there are different candlestick confirmation: hammer, bullish engulfing, bearish engulfing. I have explained all of this in a separate video, candlestick video. You'll find the link in description or even on the I button. Next, risk management with Fibonacci. Where do you generally place stop loss? When you apply the Fibonacci indicator, if you apply the Fibonacci indicator, let me take from a good high to low. Yeah, this high to this low. So when you just tap onto it and go to its settings, you'll find so many zones. These many zones are there. But the main zones, this is the main settings for Fibonacci. You can copy it in your trading view. 0, the 0.5 level, 0.681 level, and 1 level. The zone between 0.5 and 0.681 is the golden zone. So how do traders generally place stop loss? This zone is basically traded as the, people generally trade in this zone, and stop loss, risk reward, depending on their risk management also they place, but few people like to place it above the previous high. Few people like to place it according to the risk reward, but few place it according to Fibonacci's previous zone. You have multiple zones like this. If you just tick few zones, you start getting multiple zones onto your screen. Now if you're trading this zone, you can put your stop loss below this, and if you're trading this zone to sell, you can put your stop loss above this. So people use Fibonacci as a stop loss zones as well. Now what are the real chart examples and mistakes to avoid? First is when price gives a pullback at 61.8 Fibonacci level and forms a hammer candle. These are like other few setups. When it gives a pullback, you can put your stop loss at 78.6 level and put a target at 161.8 level, getting a 1:2 risk reward. This was for bullish example when market is an uptrend. And for bearish example, if it rallies to your key zone, which is this 50 to 61.8, then after a bearish engulfing or candle confirmation, you can put it about the swing high. Now don't force random trades. Fibonacci does not work at all in a sideways choppy market. Do not ignore the trend. If trend is completely clear like this, only then you trade. In sideways market, you are gonna end up losing and blowing your entire capital. And yeah, that was for the video. If you have any sorts of doubt, you can ask me in the comment section, or you can find my Instagram link is in the description. You can message me if you have any sorts of doubt. And yeah, happy trading.